So today we're going to do something different. We're going to talk about 5 charts and 5 charts only, because sometimes it's just difficult to find the time to record a full-length video, and most recently they've been much longer, between 20 and 25 minutes. So instead of waiting to find a time to do so, I wanted to maybe try a few of these shorter ones to at least get the analysis, or to keep the analysis pretty consistent. So let's get into it. 5 charts, starting with chart number 1, bearish patterns. Now, we just talked about this on X earlier on Tuesday, citing that at least at the lows today, the S&P was down over 1%, and it would have been the first 1% decline since August 1st, which was down 1.6%. So S&P's done a pretty good job fighting back today, but as we can tell, it looks pretty similar in terms of a potential bearish pattern being formed. Now, we last saw this again in August, and it seemed pretty bad back then, as you recall, because it was coming out of the Fed meeting 2 days before. Then the last day of July, we had this nasty negative reversal, would have been a bearish engulfing pattern, and then the intense downside of follow through the end of the week, down 1.6%. So there was a pretty good feeling amongst traders, again, knowing that August typically can be more volatile, that this could turn into a major top. We know that didn't happen, because as a result, we saw a pretty strong bid come in over the next 2 weeks. We had that 5-day losing streak, which only amounted to not even 1.5% at the time. And that was followed by, of course, a Jackson Hole announcement. And then the S&P made new highs once more. So now we're dealing with, again, a potential pullback. And if this continues to sell off, again, we can see how it can be pulled back down to the level it was before, near 6,200, potentially create a lower high, and then another bearish pattern. As we stated on X, and as we talk about a lot, failed bearish patterns that do not play out, of course, are just continuation patterns within an uptrend. We've seen it time and again, and that's one of the reasons why the S&P has been able to remain within 3.5% of any of its highs recently. So chart number 2, monthly winning streaks. Let's not forget that the S&P now is coming off of 4 straight months of gains. As we can tell here, still hasn't reached 5 in a row. That's important because we have these monthly winning streaks going back to 2017. And most of the time, we've seen some strong action in each one of them. So as we can tell, in every year, except for 2022, the S&P has had at least one time where it had a 5-month winning streak, right? Twice last year, once 2023, so forth and so on. It's pretty easy to see here. So if you think about it, for that to happen again in 2025, it would have to be in September, because there just aren't enough months left in the year afterward. So do we need that to happen for this market to continue higher? No, but it still is pretty interesting to see that, again, in every other month except the bear market, that did occur. So that's something to be looking at going forward. It just shows us that things can last longer than we sometimes think they can. It's been proven over and over again over the last few months. Chart number 3, kweb China Internet. Now, this is also a monthly chart, and it stood out because kweb was up almost 8% last month. One of the best performing ETFs that we look at, as well as being a very clear relative strength leader within the growth area as well. The NDX, for instance, was only up not even 1%. So it really stood out from that perspective. We care about it most because of its bullish pattern. In fact, 2 of them. So again, monthly chart, log scales. This includes obviously a number of years back, but it's come back very well. Percentage-wise, it's up a ton, and it continues to make higher lows along the way here. So as we can tell here, this could be a potential bullish cup and handle pattern going back to the lows in 2022, and then just over the last few months at least, could also be forming a double bottom formation. And so from here, a measured move on a percent basis would bring them back up to the mid-50s. But along the way, we can see some potential stopping points here at 38.2 retracement level, which would be just about 50. And also this area here, which is just the consolidation zone we saw at the end of 2021, which was about 55. But as we know, it's way off its highs from early 2021. So it does give us the idea of what the much bigger implications could be if, in fact, we get through 40 and this continues to form bullish patterns along the way. Number 4, GLD gold versus GDX gold miners. And so on a weekly basis, we know that GLD, first, it's come back very well over the last 2 weeks, so getting a little bit short-term extended in itself, but not compared to the GDX gold miners. Actually hit a very long-term target of ours just last month, and GDX was up a good amount, of course, in August. So that's just produced this very severe downtrend of GLD versus GDX to the point where, as of this morning, its weekly RSI has gotten to nearly oversold territory for the first time since March, April 2022, which of course then led to an extremely strong relative rally, GLD doing much better than GDX over the ensuing number of months. And so if that were to occur again, it would just mean that, money is maybe coming out of GDX, or at least going more aggressively into GLD. And as we know, GLD, just like gold, both of them are trying to take advantage of a 4-month or even 5-month at this point trading range, which looks like a bullish pattern, just one of the many bullish patterns that GLD and gold both have broken out of over the last few years. And that's an area that I would look to see as a potential breakout. And of course, that would be a viable breakout, considering that gold continues to be in a long-term uptrend. So just waiting for the next continuation pattern to unfold. And lastly, XLV Healthcare. XLV was the best performing sector in the S&P 500 last month, after being the worst performer in July and really being a very obvious laggard in the months before that. And so this was interesting, and still is, because that rally came after touching a very important support zone, or a confluence of support here. This is an uptrend line drawn from the 2009 lows. It extends up, comes very close to the 2020 COVID low, and extends higher from here after a pretty intense sell-off. So even though XLV really hasn't taken advantage of this yet, and obviously has lagged since April, it hasn't gone down much either. So it's held in there. And so we know that August, when it did well, a lot of that was because of Berkshire Hathaway saying that it took a pretty substantial stake in UNH. That helped. But again, it helped push along investors that were trying to buy the dip the whole time, and in names like that, it's finally got XLV going. Also happened near this 120 support level, which was an area that XLV had held above in 2021, 2022, and 2023, all of which suggests that this could still have legs and move much higher going forward. So before we go, if you haven't yet, I urge you to subscribe to our free Substack newsletter entitled CappNotes. We talk about it a lot, CappNotes.substack.com. As you can tell here, we put a lot of timely analysis on here. On occasion, we'll throw in full-length opening look pieces, which we go into really deep analysis for the day. We talk about all the daily statistics, breadth, internals, so forth and so on, with a real focus on S&P 500, its pattern work, and all the studies related to it. We then have the next section, which is full ETF breakdown. We look at all the actual ETFs that are out there, and also the last part being chart trades, which are just trade ideas based on charts with entry levels, stops, and targets. Again, that's CappNotes.substack.com. See you there soon.